dear to my heart for so many reasons, and Phil has been a good friend of mine now for about 20 years. I just mentioned somebody, and he happened to know that person, so I'll introduce him in a little bit more. I know he's really busy, but I want to bring Adrian. I know Adrian has some good stuff that she wants to tell us, so come on over and tell us, Adrian. Give her a hand, guys. Come on. Yeah. You want to just hold this?
No, I'm good.
Oh.
Good morning, everyone. Something that comes up a lot in escrow, not a lot, on my desk it comes up a lot, are power of attorneys. I wanted to explain a little bit about what a power of attorney is in case you don't understand. And I gave you a little sheet. If you keep it, put maybe a little tab on it that says power of attorney, keep it in your drawer. Anytime that you need one, it's there for you. Okay, power of attorney is used when the person that needs to sign the documents cannot be there. Okay? You can execute it to anybody that you trust. So the person that's signing the power of attorney, giving their power to someone else, must be of sound mind. It needs to be approved by, I draw it, by the way. If you need a power of attorney, you let me know. I prepare the document for you. We have the title company approve it to make sure the form is still acceptable and it will work for the transaction. If it's the buyer that's using it because husband or wife, one of them travels a lot and won't be there when the docs are signed, let the lender know you have a power of attorney. We send it over to them, we give their approval up front. These aren't things that you want to surprise the lender with. They have to draw docs accordingly. Okay? Power of attorney has to be signed in the presence of a notary. It's only valid for a certain period of time. Normally, you can give it, years. The title company will not accept it on a real estate transaction. It has to be within 1 year, and they need the original if it has not been recorded within that year. On the power of attorney, I put up here where it says signatures and initialing. There's a very specific way that people have to sign. So if you're signing, John Smith cannot sign the documents. He's out of town for 3 weeks. Loan docs are coming in. He can't sign. So his wife's going to sign. So every time there's a document that says John Smith on it, she has to physically write in handwriting, John Smith by Mary Smith as his attorney-in-fact. It has to be in handwriting. Cursive. It has to be in handwriting. When they initial for somebody, this includes your RPA. If that one of those parties cannot sign your purchase contract, the seller's older. In assisted living of sound mind, their son or daughter is going to sign for them. The person that's signing the power of attorney must sign. Every time there's an initial, it would be JS by JS, every single initial. And they write JS by BY in handwriting with the other initials of themselves. When somebody wants to use the power of attorney, the person that's going to be signing for them, don't have them sign, if they've got a name that's 5 names long, don't use them all. They have to sign that. If it's for loan documents, they're going to sign 100 times. John Smith by Mary Smith as his attorney-in-fact. So don't make it Smith. Don't make it Mary, Jane, Beatrice Smith. Just make it easy on everybody that way. And so on your purchase contract, if you can get, if it's an older person that's in assisted living, you're going to have to sign that power of attorney in front of the notary anyway. It might be best to have your purchase contract signed by the actual seller, and then use the power of attorney for follow-up documents so that you don't have to do that. You can get the grant deed signed by the actual seller, that's even better. And again, use the power of attorney for follow-up documents. You want to make sure that seller is committed to that. He knows what he or she knows what they're selling. Okay? So just take this as a little guide for how to sign, and I hope that helps you.
Thank you. Thank you, Jen. All right. So like I was telling you guys about Phil Antwan, he was just telling me that he's fresh from Dubai, Abu Dhabi, and without Cairo. and he presumes that he needs to go out and take another vacation. So I find that very hard to believe after, But anyways, he's come very excited. I know he vacations a lot now with his family. But for 20 years, he's helped me and a lot of the people that I know with 1031 exchanges. He is the director of the Escrow Association, Adrian. This man is the director of the Escrow Association. He speaks at every escrow association in Southern California and maybe Northern California, I don't know. I was just mentioning somebody who started the business with 20 years ago. Adrian Vetcher is actually a software developer for an escrow company, which is a friend of mine. I said her name, he was like, oh, I was an investor with her. I know her. So this is a very small world. Adrian is very influential when it comes to escrow and software and companies, and he happens to know her as well. So one of the things I've done with Phil differently last year that I encourage you guys to do is get a whole bunch of customers together and do a class where he teaches. Okay, we did that last year. It went really well. Those people happen to be tax preparers. There's, I think we had about 7 or 10 people there. They were all tax preparers. They all have their own business. So we get it. We got them at a friend of mine's office, and he went and spoke to them. And guess what they know? They have the customers that own a lot of the real estate and the ones to exchange and do all that kind of stuff. And he was able to tell them what to do. So I really encourage you to talk to Phil and put a class together. I know for you guys to take the Buffini class, they say put a class together for customers and stuff like that. This would be perfect for you to do. And anything you suggest to him, Phil meets with my clients outside freeway lines, in coffee shops, somewhere, anywhere they meet. Basically, sometimes I don't know, I just know that he's handling it. And then I get a call from Nicole Savage, who I haven't met, but we talk all the time. She handles all the paperwork. So I'm always very happy that I can make that phone call and say that I know he's going to handle it. So I'd like to give him a warm welcome for my friend and yours, Phil Antwan.
I don't know if I deserve such a wonderful welcome. I don't know if I deserve such a welcome like this. We're on, okay. But I'm really honored and happy to be with you here this morning. And this is being recorded. Are you going to put this on YouTube or something?
It'll be for our turn.
Oh, okay, because a lot of these people are beginning to put these speeches on YouTube. So if you ever want to go, just go to YouTube and type in my name, and you'll see a number of these on there already. So I'm happy to help out any way I can for you. We're really busy, folks. Why are we so darn busy? Outside of wonderful escrow officers who are always taking care of us and, sending their clients to us. It's because the investors are moving their properties around. For what reason? They're moving their properties around because they want more of what they originally were looking for. What does that mean? Do I get rid of my wife to find another wife? To get more what I was looking for? That doesn't make sense. In fact, just to set the record straight, next month is our 29th anniversary, so everything's good. Yeah. Thank you. Yeah.
No replacement, huh?
Yeah, no replacement. No 1031 exchanges on wives. Though, the government's very concerned about people that are moving their properties around with LLCs and corporations, and they dissolve. They call them swap and drop. And, of course, we're not talking about California marriages, swap and dropping. But there are other aspects of the exchange, which we can talk about later, I guess. But the reason why people are selling their properties is for the same reason they bought them in the first place. They're looking for more cash flow. Cash flow is really important. You should be buying these properties for yourself and let the properties work for you so you don't have to. That's exactly what these investors are doing. They're selling their properties to get better properties that will give them more cash flow. How many commissions do you get a month? 1, 2, 3, maybe 1 every 2 months? I don't know what your business is like. But if you have a door that's producing rent for you every month, that's a real motivation to buy property. Let it start working for you. That's why these investors bought the property in the first place, and that's why they're going to do what? Sell it to get better properties with more doors they're going to pay them more income. Number two, I noticed you had donuts in the back. Well, investors don't want donuts. They want their cake, and they want to eat it too all at the same time. What does that mean? That means that they want the property to be worth more than what they paid for it, and they want cash flow all at the same time. And that's exactly what you sell. You sell property that will go up in value. I can't tell you, being in the business, as long as I've been in the business since 1982. When I first got into the business, and this was in the title end of what I used to do, interest rates had just dropped. You know how interest rates go up and down? They just dropped to 18.5%. I've watched the market change. But let me tell you something. I've seen so many people who have bought property for their businesses and then eventually shut down the business, or the business goes out of business, or they retire, and the property is worth much more than the business ever was. They want to have their cake and eat it too. They want to see it go up. Why? Not only is it producing equity and money for them, but what they can do is they can take the equity and buy more properties that are going to go up in value. Instead of putting all the equity in one building, they'll spread it around. Now think about this. Let's say I have two properties here, 1 and 2. They're same property, same street, right on the corner, same floor plan, same square footage, same condition. This one is fully paid for, no debt. Pretty good, huh? This one is leveraged. It's only paid off 50%. It's leveraged 50%. Here's the question. Which property can I charge more rent on? This one that's fully paid for, or this one that has a mortgage on it? Which one can I charge more rent on? The answer is, somebody says this one, somebody said this one. And both of them, those are the wrong answers. You see, equity has nothing to do with how much rent you can charge. So what's my rate of return on the equity for this compared to this? This is actually higher because I have less equity invested into it, and it still earns the same amount of money. Yes, I have to pay the bank each month, but the actual rate of return for the equity is higher on this. And guess what? I don't have as much equity into this property, but it's going to inflate as much as this one will in terms of appreciation. That's why putting all your equity in one property is not smart. It is for your home because you live there. Your investment properties, you don't live in. You bought them to make money. So you don't put all your equity in one building. You spread it out so more properties can go up as equity goes up, and your rate of return for your dollar has to be up so you can make a nice cash flow. Not to mention the write-off for your taxes on the interest. Does that make sense?
Absolutely.
Number 3, not just cash flow. By the way, how many paychecks do you want a month? 4? Then you'll have to get a 4-unit building. You want 10? Isn't that something? Get over 2 a week. But that's what happens with investment properties. And guess what happens, by the way, with the equity? I'm sorry, with the cash flow. Rents just keep going down, right? You keep getting raises. And that's the beauty of that property. And that's why people buy this stuff. Lastly, number 3, they need a tax write-off. They need something to write off to offset the income that's coming in so they don't have to pay the government as much in taxes. Now, everybody's in a different tax bracket, and I understand that. But here's the deal. When you start getting, 5 units, 7 units, 10 units, 12 units, 15 units. And when I say units, it doesn't have to be all in one building. It can be multiple properties totaling that many doors that are paying you rent. Well, guess what happens to your tax rate? You start paying, the government says, we want to get to know you better because I want more what out of you? I want more income out of you, more taxes. So not only do your taxes go up because you have more money coming in, but then they raise the percentage that they're going to give. And you go like, how's that fair to me? I'm working very hard. I took all the risk. I'm the one who's putting the blood, the sweat, and the tears. But now they want not just the taxes, but they want to increase the percentage that I give. Do you know how much money investors are paying in taxes after write-offs? It depends, of course, on the tax bracket, but up to 55%. Can you imagine you getting a paycheck after the close of escrow and giving half of it to the government? I bet how you vote will change. The whole point is that it's crazy. And that's why they need something called depreciation. And that's the beauty of owning investment property. The government allows you to write it off, which reduces the amount of taxes that you pay because you're making more money off your rentals. That makes sense? We won't go into all the details of depreciation because I don't know how much time we have today, but the bottom line is that's going to take me a little bit of time. We can come back and talk more about it another time. Depreciation is really important to an investor. Releveraging is really important. Releveraging by not leaving all the eggs in one basket, spreading them around. You know, I've got plants. I think I've shared this with you once before. I've got these certain plants. They've all bloomed a couple. See, it's my luck. They're all blooming with these beautiful flowers. And now I looked this morning, and most of them are all gone. Of course, our big Memorial Day barbecue is on Sunday, so they won't be bloomed for that day. That's not my luck. But how did I get all these plants? The answer is, well, they just keep growing. So I transplant part of it into other parts of the yard. And all of a sudden, I've got this stuff all over the place. Does that make sense? Well, that's what people do with their property and the equity that grows in it. But the problem is when I sell the property to do that, I have to pay what? Capital gains taxes. Whether it's my home, whether it's a vacation home, or whether it's a rental or a commercial building or where I put my business in, I have to pay taxes. Well, how does the government calculate taxes when I sell a building? As soon as I close escrow, the government stands up and applauds. The state wants 3 1/3% off the sales price as a withholding. The feds want their money eventually when you do your tax return, or you may have to do quarterly installment on the gain. But the question is, how does the government tax us? Is it based on the equity in the building? The answer is no, it's not. It's based on something called the capital gain. So what's the gain in the property? Well, let me give you a really quick tax lesson. Whatever you paid to buy the property, whatever that price was, that's called your tax basis. So if I bought a property for $300,000, that would be the basis of the property, the tax basis. Now, the basis will change every year depending on what that property is there for. If it's for a rental, I'm allowed to do what to it? Depreciate it. Well, that technically lowers the basis. The basis actually goes down. Well, what makes the basis go up? Again, this is very simplified. But the basis actually goes up when I do something to the property called a capital improvement. Not a repair, not paint and carpet, but actual capital improvements. What's a capital improvement? If I add on to the property, if I remodel and upgrade, so if I do bathrooms, kitchen, add-ons, upgrade the roof, not repairs, not paint, not carpet, but actual improvements to the property. Maybe I put a new concrete driveway in, maybe I put better fencing around the property. Whatever I do to make that the government considers as a capital improvement, it's like putting money into the property, so that purchase price, that basis, actually goes up. Because at the end of the day, the sales price minus the adjusted basis equals my capital gain. It has nothing to do with equity in the building. Now think about this. What if I already had spent the equity in the building? I treated it like an ATM machine, also known as a refi. In fact, it's really interesting. I was just talking to a lender, and in fact, I've asked this question of many lenders after this first lender told me this. Did you know, based on, and this is obviously not non-scientific. Did you know that between 30 and 35% of all the refis going on today are to pay off credit cards and debt, not to buy another property? That's really sad. So it has nothing to do with equity, because if you take money out, the government says, okay, but we're not basing how we're going to tax you based on your equity. It's the sales price minus the adjusted tax basis equals your capital gain. So if I bought it for 3, let's just make it really simple. I sell it for $700,000. I bought it for $300,000. The capital gain then is roughly $400,000, and of course closing costs and all those other things will factor into it too, but just to keep it simple, $400,000. Well, guess what the government says? You pay taxes on $400,000. You say, I don't have any equity. That's not my problem. Government says, it's your problem, because you have to pay the tax. What if you don't have enough to cover the 3 1/3%? You darn right, because you don't close without it. The government wants their money. Do you know how you spell the IRS? T-H-E-I-R-S. You know what that spells? It spells theirs. I didn't make this stuff up, folks. I heard it from somebody I thought was pretty good. But the bottom line is that they want their part. So what do they want? Well, it depends. If I up to 20% on what they call a long-term capital gain. What does a long-term capital gain mean? That means I've had title to the property for 12 months plus 1 day. That changes my tax bracket from 40 to 20 because I've had title to the property for a year and a day or longer. It could be less than that, depending on your tax bracket. Number 2, anybody ever heard of the health care program?
Which one?
Which one? Well, we don't know. I think it's changing. Do you know that after $200,000 as an individual of gain, or if you're married filing a joint return $250,000, you have to pay for that program? 3.8% goes to the IRS to pay for that. Number 3, did you know that in the sale of property? Number 3, you have to pay California. Well, you say 3 1/3%. No. 3 1/3% is the withholding off the sales price. The real tax is between 9 and 12.5% of the gain. See, the 3 1/3 is an advance. Can you imagine paying the government every time you get a paycheck? Well, we need an advance on the taxes. We're not going to wait till next year or to the quarter. We want it in advance. We want it now. Well, that's what the state does. They want it in advance of 3 1/3%. But really, the real tax is going to be between roughly 9.5 to 12.5, unless you're over $1 million a year. And if you are, and a lot of these investors are, then it goes up to 13.2%. Yeah, or 3, whatever it is, 13.3. And if it's a rental, they charge you a 4th tax. It's called the depreciation recapture tax. You know the write-off I just told you about? They could depreciate it? Well, the government says that when you sell the property, we want to tax you on the tax break that we gave you. We allowed you to depreciate the property, so as long as it's in service, you get this thing called allowable depreciation. Well, when you sell the asset, the government wants a 25% tax on what was depreciable, what was allowed to be depreciated. Get this, whether you took the write-off or not, just because they allowed you to do it. Michael, yes, sir.
Yeah, for the
Relax here, I'm going to take my jacket off.
For the benefit of everybody here, can you just briefly tell them what depreciation is and how it works?
Depreciation is, if I bought the property for $300,000, like we just talked about, well, the government breaks your CPA will break your purchase price into 2 categories. The value of the dirt, the land, and the value of what they call the building or the improvement. In fact, for those of you who own homes, each year you get this wonderful little note, what is it, around September or October or July, whenever it is, from the Los Angeles County tax collector, right? And they tell you what the assessor has assessed your property at. And they break it down into two areas, value of the and value of the building or the improvement. Well, the government says that your CPA will break down your purchase price into those two categories. Now, obviously, the closer you get to Beverly Hills or to the ocean, the higher the land value is. But as you go out that way, the value of the land goes this way, and the purchase price gets heavier on the what? On the improvement. Well, they allow you to depreciate that, if it's a rental, that improvement value over 27 and a half years. Whereas on a commercial building, they give you 39 years of depreciation. Now, which do you think I like more, 27 and a half or 39? Who says 27 and a half? Who says 39? The answer is 27 and a half. Why? You say, well, that's less. Yeah, but the thing is, if I have $200,000 worth of improvement off the $300,000 purchase price, I take 200 and I divide it by 27. That's a much higher number than 39. So I get more depreciation, even though it's in a shorter period of time. I mean, how long am I going to own the property, right? So I would rather take the 27 and a half. What if I have a 50-unit apartment building? Is it commercial or is it residential? The answer is, well, to your lender, it's commercial because they're going to stick it to you on points and fees. But the government says it's still a residential building because people live there. Does that make sense? What if I have a split use? Well, I see this all the time, where we have commercial on the bottom floor and residential units on top. The answer is they get both. The value of the downstairs versus the value of the upstairs, and the CPA will work it out and put you on two different depreciation schedules. But does that kind of answer your, and that depreciation thing is a great thing, but when you sell the property, the government wants a 25% tax, regardless of your tax bracket, on that money. Now, I don't live in Lakewood. We're in Lakewood, right? Okay. Okay. I live in Whittier, so I'm right up the street. In fact, I live right next to the Rose Hill Cemetery. Everybody knows where that? I have very quiet neighbors. Except for all these darn processions that clog up traffic. People are just dying to live there. That's right. They're just dying to get in. Well, if I was selling my primary residence, and let's say this scenario where I sold it for, what do we say? 700, and I bought it for 300, and the difference would be what? 400. Well, that would be a capital gain. Now, can I do a 1031 exchange on the sale of my home? The answer is no, because to qualify for a 1031 exchange, it has to be a what? Rental, investment, or business use property. It doesn't qualify for that. So do I pay the taxes on the sale of my home based on the capital gain? The answer is, well, the government gives me something called the 121 primary residence exclusion. You should write that down so you don't forget. 121 primary residence exclusion. It excludes up to, since I'm married filing a joint return with my wife, up to $500,000 of capital gains. Capital gains means the health care tax, the long-term capital gains tax. There won't be any recaptured depreciation because I'm not allowed to depreciate my home that I live in. It's only for business use. And the state tax. I'm excluded of up to $500,000. But in my example, if I sell it for 7 and I bought it for 3, the capital gain is roughly, so the 500 what? Excludes me from all gain, which means I pay what? 0 in capital gains taxes, including the healthcare program. And so escrow is not going to withhold because it's your primary residence. Very good. What if I have a second home? Like in Palos Verdes or in the desert or somewhere, nice. My wife prefers water. So anyway, San Diego, whatever. Do I get to do the 1031 exchange? It doesn't qualify. It's not business use. It's personal use. How about the 121 primary residence exemption or the exclusion? No, it's not my primary residence because the qualification of the 121 exemption is that I have to own it for at least 2 years. Well, I qualify for that. because we've been married, like I said, next month is 29, and we bought it in October that same year. So I've owned it for 29 years. I've lived in it for almost 29 years. He said, but on your second home or vacation home, it's not your primary principal residence, so it doesn't qualify for this $500,000 married filing a joint return with your spouse exclusion. Or if I was single, it would be how much? $250,000. So would I be able to use any one of those two, the 121 or the 1031? The answer is neither. I would have to pay the entire capital gain tax on that. Number 3, own it and live in it for 2 out of the last 5 for an exclusion. Primary residence, nothing on a second home. Can I convert that second home into a rental? Yeah, I can, but I would have to wait for 2 years. It's really technical, but just say 2 years for now. So if I hold it for 2 years, I can later on sell it and do what? Do a 1031 exchange. What if I convert that second home into a principal residence and then I live in it for 2 years? Can I get the $500,000 after living in it for 2 years? So now it's been my principal residence for the last 2 years, and I've owned it for a bunch of years. So can I get the $500,000 since I'm married filing a joint return?
Isn't that a one-time exemption?
That exemption is only good one time every 2 years. I just saw around the corner you have a UCLA thing and a USC thing. I felt the tension as I walked by those two banners. Just think of USC, fight on every 2 years. I'm a Trojan, by the way, just in case, even though I'm wearing blue today. Which is really weird because I teach classes at UCLA on this very subject. Anyway, so the bottom line is that one time every 2 years you can take the 121 principal residence exclusion. Every 2 years and 1 day. So let's go back to our situation. I convert my second home, or even a rental, doesn't matter. I convert it. Not that kind of a conversion. I convert it, that means I move into it. I already own it. I just never used it for personal use, but I convert it. Can I get the 121 exemption?
2 years and a day?
After I lived in it for 2 years and a day?
Yes.
The answer is yes, but it's going to be prorated from 2009 because Congress back then put in a new law that says if you do a conversion, not that kind of conversion, and you move into the property, they're going to look back at 2009, January 1, and they're going to say, how many years since January 1st, 2009 did you live in it as a principal residence, and how many years was it not a principal residence? So let's say it is 2 years, so let's say it was 10 years, and 2 of the years out of the 10 were principal residence. What's the ratio of 2 to 10? 20%. You get 20% of the 500, which is 100. You get 20% of the 250, which is only 50,000. So you have to be careful because it's a principal residence, you don't know what the client did to move into it, or if it's been a principal residence the whole time since they bought it. So who should they go talk to find out what their tax is should they sell the property? They're tax people, right? Because, Michael, everybody's licensed here to give out tax and legal advice, I hear. Is that correct? I don't think so. Oh, that means you better not what? Give it out. Have them, tell them, I think it could be this, but you should go talk to your... Because every time they'll say in front of a judge, you told me. Now, who's the judge going to believe? The deep pocket people at Realty Executives, or the poor, innocent person who was stupid enough and cheap enough not to go talk to their CPA to consult? Who are they going to believe? They're going to believe them and charge you the tax. You have to pay their legal fees while you're at it. And that's just the way the court works. So you have to be that's justice, right? Liberty and justice for all? I don't think so. So you have to be careful. So the bottom line is, the exchange is only for what? If I have a investment property that, what's an investment? Can I hold vacant land for investment? Sure. How about a business use property where I have my factory and all my employees are there, or I own realty executives and I have all my agents here? Is that used for business? Absolutely. How about if I buy something for income use, like a residential building or a commercial building where I rent it out, or a triple net lease building? Is that held for income use? Yes. Any one of those will qualify for the 1031 tax deferred exchange. Now, what does that mean, tax deferred? And what do I have to do to get it? Tax deferred means this: you're not getting away with your taxes. You just don't have to pay them now. So remember that low basis of $300,000? You get to take that with you to the next property. So the capital gain stays with you. You just don't have to pay it until you cash out. But what if you don't cash out? What if you keep it going and you do a couple of exchanges, or you just watch it appreciate, and now you're 90 years old, you look like me, and, and you're 90 years old, and then all of a sudden you decide to sell the property, and the property is worth $2 million. By the way, am I exaggerating, $2 million? That's why you should buy this for yourselves. Quit making your clients money. I mean, don't stop making them money, but do it for yourselves. Start with a condo. If you aim at nothing, you'll hit it every time. That make sense? It's amazing. I hope you don't get mad at me, gentlemen. All right, don't get mad at me. What I'm going to tell you, you're going to make more money owning property than you are going to be selling the property. Right? The wealthiest agents I know own property. The wealthiest people I know in general own investment real estate. Now, so I have all this equity, and I am 90 years old. I decide to cash out, and it's worth, what, $2 million? $2 million minus, let's just call it a basis of 300 equals what? 1.7 million that I would pay taxes on. I don't think so. So hopefully I'm smart enough, and I put it into a trust or something like that. I consult a good estate planning attorney, and I put it in a trust, and then one day, guess what's going to happen? I'm just going to roll down the hill and be with all the other brethren down in the holes there in the ground, right? At Rose Hills. And I die. So my kids say, God bless Mom and Dad, but let's just take the $2 million and sell the building, and we'll give Michael a call, and we'll list the property, we'll sell it, we'll just split the proceeds amongst ourselves. Do they pay the capital gains tax at that point? The answer is no. You said no. Somebody said yes. Well, which one is it? The answer is it depends. See, since I was smart enough to put it in a trust, you can do this without a trust, but I think you're better off with the trust. Whatever the value is of the property when I die, that becomes the new basis to the living. The dead are gone. See, I go to my heavenly reward. But the living get it at the value at my date of death. So if they turn around and sell it for $2 million, what is their capital gain? You know what the technical term of that is? Don't forget this. Swap till you drop. Isn't that cool? It's wonderful. And that's the beauty of watching the appreciation and letting the property work for you, or selling it to buy better property. They will do more of that for you. And if you sell that to buy another property, you have to do something called, so you don't have to pay the tax, called a 1031 tax deferred exchange. 1031 is not the time right now. It's just passed. It's part of the tax code that allows you, through this exchange program, to sell and reinvest. You have to buy for equal or greater than what you sold for. The only thing that can come out of the proceeds of the sale are the non-recurring closing costs. What is that? Escrow. your commissions, those are all one-time cost to sell. Title insurance, one-time cost to sell. Transfer tax, one-time cost to sell. What about association fees? Those are ongoing fees. What about property taxes? Nope, those are ongoing taxes. What about insurance? Nope, that's ongoing fees. What about maintenance to the property? What, this lady calls me or sends me an email at, I don't know what she's doing at 3 o'clock in the morning. She obviously couldn't sleep. So she sends me an email, of which I didn't look at until about 7:30. And it said, well, can I get back all the improvements that I put into the property? The answer is no. The government is allowing you to defer your tax. Only the non-recurring costs to sell could come out of the proceeds. So remainder of the cash has to go into whatever I'm going to buy. The government says it's like-kind, and I'll talk about that in just a second. It's got to go back into the like-kind property. And if I have mortgage on the property, it's going to get what? Paid off when I close the sale. Who's going to pay off, by the way? The escrow company or the title company? Title company. Why? Because they're the ones who are insuring the title. And for them to insure the title, they have to make sure that it was really paid off. And that's why they charge you something called a sub-escrow fee. Very good. I'll need a good escrow officer would know that. That make sense? So the bottom line is, I have to make certain that I take on as much debt on the new property that was paid off on the old property, and I have to transfer all the equity into the acquisition. That's roughly equal or greater than what you sold for, minus the non-recurring closing costs. If you do that, and it goes into a like-kind property, the government, through the accommodator, will allow you to do that thing called a 1031 exchange. Now, here's the question. What is like-kind? What if I'm selling an industrial building and I just want to buy a 2-unit complex? Is that like-kind?
Yes.
The answer is, who says no? Who says yes? Who's not sure? Who doesn't care? Who wants a donut back there? The answer is, yes, it is like-kind. So wait a minute, time out. How is a commercial, C-zone or whatever, industrial, like-kind to a residential? The answer is because you're selling investment real estate and you're buying investment real estate. See, it's got to go from one property to other property that you don't already own that you're going to acquire for either investment or business or income use. Does that make sense? And that's what an exchange is. So literally, I could even buy vacant land and it would cover, because I would buy the vacant land with the intent that it will what? Go up, appreciate investment. Does that make sense?
Yes.
So I can buy this property where? If I sell in California, I can buy it anywhere in the world? No. In the U.S. Anywhere in the country. Can I go outside of the country? People call me, can I buy in Costa Rica? The answer is no.
Puerto Rico?
What about Puerto Rico? No, I said Costa Rica. But can I buy in Puerto Rico? Like what are like a U.S. territory? What's a U.S. territory? Guam, Virgin Islands, Puerto Rico, Syria, Iraq, Afghanistan.
It will be. It's coming.
Guantanamo Bay. No. What? No, I'm just kidding about this. Maybe not. No, I'm just kidding. But the bottom. Mexico, if that wall doesn't go up. I don't know what it is.
It's just gonna knock the wall down.
Did you see that? Did you see that? That was so funny. You know how President Trump was at the Wailing Wall, in Jerusalem? And did you see somebody, how people write these stupid captions on these things? And he goes, oh, your buddy's going to be born here pretty soon. I thought it was funny. I don't know, people come up with it. If you can't laugh, it's like, well, what was I talking about? No. I can buy anywhere in the country, but probably not in a U.S. territory. It's very, very, very rare. Your CPA, who probably won't know the answer, has to do some research to find out if you have a business and a certain type of a corporation down there. They make you do all kinds of handstands to be able to exchange into U.S. territory. But Costa Rica is not a U.S. territory. Mexico is not a U.S. territory. Yeah, no, it's not. So,
Not all of Mexico.
not all of that. Just a, you're funny.
I think it's the opposite, isn't it?
Anyway, but anywhere in the country. Does that include Hawaii?
Yes.
Hawaii, Alaska, New York City, Compton. You're funny. Washington. That's foreign territory. Anywhere in the country. Anywhere in the country. And that's the beauty of an exchange. You can go to any kind of investment property as long as it's not your second home or vacation home or your principal residence. Any kind of investment property anywhere in the USA. Does it have to all go into one property? No. You can split it up and buy different properties as long as you reinvest all the equity and take on as much debt on the purchase that you paid off on the sale of the old property. So if I sell one for $1 million, I can buy one for $400, one for $300, and another one for $400. Is that right? Did I do my math right? Is that right? As long as I buy equal or greater, the government's okay. Reinvest all the equity, replace the debt. That's all it is. So, how do I set up a 1031 exchange? Did I hand out any of these? Yes, I did.
The booklets are...
Yeah, the booklets. Oh, you already have your booklets? Okay. So how do I set up an exchange? The answer is I need to ask questions when I'm taking a listing. How are we doing on time? 10 more minutes. I have if I could take it all in 10 minutes. Okay. For those of you watching in computer land, forget about it. No. Okay, really quick. I have to ask a question when I take a listing. Why are you selling the property? What do you plan on doing with the dinero? What are you going to do with it? Especially if it's a what? Tenant in the property. I need to know if it's business use or if it's a primary residence. You know what? Why would I be so nosy to ask them what they're going to do with the money? The answer is because they may have to pay what? And if they're going to buy another property, I want to be the agent. Now, I'm not licensed, but if it was you, who takes the listing and helps them buy the new property, the replacement. So, I don't know, is it true that 2 commissions are still better than 1? I thought so. I mean, that would be like saying 2 escrows are better than 1. I have no problem with that one either.
How about your wife?
You know, it's funny. We were on vacation, and we were in Abu Dhabi. Then we went to Dubai, so we had a driver. And this one guy, he's like most of the people who live in Abu Dhabi. Do you think they're Arabs? They're Indians, and they're Filipinos, and some of them are from Bangladesh. They come to work. They're so outnumbered there, but they're all work for them. That's how much money these people have. So anyway, he's driving us. And he was talking about his wife, then he talked about his other wife, and we're thinking, you know, maybe he got a divorce or whatever. Who said something about a second wife? They brought it up, not me. It turns out he's got 2 wives. And he was telling, my wife said, look, I hope you're not offended, but I got to ask you some questions here. I was like, how do you go on vacation? Like, do you have to ask the other wife permission before you marry the second one? Now you got 2 of them? Do they get along? He has all these really weird questions. The answer is well, you know, unless you live other places in the U.S., you're not really supposed to do that. And one guy said to me, he said, like, why would I want a second wife? I have enough trouble with this one. I want 2 problems? No, just kidding. Folks, this is boring information. I got to make it to laugh. So how do I do it? I need to find out what the needs are so I can help them, what? Represent them. Then I have to hire a accommodator. So I have to put language in my contract that says the seller is doing an exchange and that the buyer is going to pay for it all? No.
Cooperate.
Cooperate.
Cooperate at no cost.
I'm not
To the
At no, you want to put down at no cost? Be my guest. Yeah, but here's the deal. You have a zip form that says that. So you know what? I hope you could remember this. Seller's intent to exchange. That's the name of the zip form. So just put it in your contract, or just simply write it in. We have language in what we just handed out to you. Seller's going to do exchange, buyer's going to cooperate. No cost to the buyer if you want to put that in. But the government says that the language has to be in the contract, which will invite the accommodator to escrow. You see, escrow is between two people, the seller and the buyer. That's it. And they have to agree on one thing. Those two people have to agree on one thing. You know what that one thing is? Everything. Right? They have to agree on everything. So for the seller to bring the accommodator to escrow, who has to agree to it? The buyer. And that's why you have to have that cooperation language in your contract. And if you don't get into in your contract, I can tell. Escrow will do a what? Amendment to put the accommodator into the contract before escrow closes. You know how many calls I get after escrow closes that I need to do a 1031 exchange? Here's the answer. Forget about it. You can't. It's backed into the docs. I suppose I could do that, but I think that's called tax fraud, which means you and I will be in the same cell together. We'll be roommates. See, now I got another wife here. This is being recorded. Strike that. But the whole point is that we have to have language in the contract, and the accommodator has to come in and set up exchange papers before escrow
Closes.
You hear that, everybody? Before escrow closes, okay. Once escrow closes, it's too what? Remember Carole King? It's too late, baby. Remember that song? You got to get it done before escrow closes. Now, once the sale closes, the government says you have time period to adhere to. You have 180 days, not 6 months, because 6 months is longer than 180 days, because it's 365 days a year, right? 180 days to do what? No, to close escrow on equal or greater in value. Any investment properties anywhere in the country, whether it's one or multiple properties. But the second part is more difficult. I have only what?
45 days.
To do what? 45 days to do what?
Identify.
How do you do that up to 3 properties in a market where there's very little inventory? The answer is you put contingency language in your sales contract that says the sale is contingent upon my being in escrow and a proven inspection report on a replacement property. I ain't closing if I don't have another one, because that 45 days in this environment goes like this. Now, I always have somebody who says, oh, I'm not going to put that language in the contract. No buyer would agree to it. Really? It seems like those other buyers have the same problem you have.
Yeah.
I can't find anything. They'll wait. In this market, they'll wait. As inventory comes up, it's not going to work, but you don't need to worry about it so much because there's a lot more inventory for you to pick. Does that make sense? Are you okay with that? I am okay with it. But the bottom line is that, But the bottom line is that you've got to know what you're going to buy before you close your sale, because there's not a lot of inventory out there. And isn't the point of the buying a new property is to get better cash flow, better appreciation, maybe more tax write-off if you buy up? Those are all re-leveraging. So why would you just want to go into it without knowing? That's like, going online and go, oh, she's pretty. I think I'll marry her. I mean, that doesn't make sense. Then she found out she's a crazy woman. No. Folks, I am so grateful I've been married 29 years. I'm going to stay that way.
Get married.
Yeah. You hear that, dear? No. Does that make sense? That's why it's really important to know what you're going to buy. You've got to make a good financial decision for yourself. And re-leveraging doesn't mean selling. It means buying better property. That's called a delayed exchange. Number 2, there's something called, we're going to wrap it up in 2 minutes. A reverse exchange says I can close a purchase first and then close the sale up to 180 days later. Isn't that nice? You can take the most important part and get it done first. Wait until you find the right property, get into escrow, hire the accommodator, and then close the sale within 180 days after the purchase closes. Now, where's the money going to come from? You have no sale. So you have to have either cash or the ability to get a swing loan or bridge loan, a line of credit, hard money, something that will get you into the purchase. So when the sale closes, it can reimburse you or pay off, all the bridge money that you had to borrow to get into it. It costs a lot more to do it that way, both from a lending point of view and from an accommodator point of view, because our fees go up a lot because of what the IRS makes us do. But the bottom line is you can purchase first through the accommodator, like any exchange, and then ultimately close the sale afterwards. That's the safest way to do it in this marketplace. Or if opportunity knocks on the door, you find an incredible property, you have no time to sell. You got to grab this property because it's a really good price and a really good location. Does that make sense?
Absolutely.
That's how the 1031 exchange works. It's great for your investors, and the more you get to, and I'm going to end with this. You see, the difference between an investor and a homeowner are two things. Number one, an investor is a homeowner, most likely. They already own their own home. See, a homeowner never will sell unless they have a need. See, they have a need to get a bigger house. They have a need to get a smaller house. They have a need because their job is transferring. They have a need because the kids have to move away. They have a need for something. If they don't have a need, they don't need you. You know how much you know when you're going to eat? When you come here on a Wednesday or Thursday morning to eat donuts. Because you're not going to make any money. You're not going to make any money. And I think homeowners are great. Takes them home, put them in the freezer. I had they last. Put them in the microwave. Now, you have to be very careful. Though homeowners are wonderful to work with. But the problem is if there's no need, they don't need you. An investor doesn't have to have a need. They just have to have a opportunity to make money. That's why they're great to work with. And they own more than one rental. Typically, an investor owns multiple properties. Next week, I'm closing in Long Beach, a little condo. It was a knock on the door. I just couldn't believe. The guy calls me up and he says, hey, I got this letter like 3.5 years ago. My son was looking for properties for us to buy so he can rent and live in it from us. So he made all these letters up and he put it in all these mailboxes and all these complexes that he thought that he would like to live in. We eventually bought something 3.5 years ago. 2 months ago, this guy calls us up. He goes, well, I got your letter 3.5 years ago and I'm ready to sell. What are you talking about? We went and looked at it. It's a little postage box condo in a beautiful complex. We're going to get a great rate of return. But I had to move quickly. See, it's about opportunity knocking. You just never know where it's going to come from. And that's why investors will work with you. Because it's all about money. It's not about where they live. Because they didn't buy these properties to live in them. That makes sense? You'll make more money working with investors. Great people to work with. You'll get more escrows. Everybody wins. Your title company will be happy because they tend to move their properties around to do better. I sure hope this has been helpful to you today. If you are interested in it, and I'm going to have to use a tough word on you, okay? It's a 4-letter word. You don't mind that I use that kind of language now, right? W-O-R-K. Folks, you got to work. It takes effort and energy to meet investors. But the title companies will give you the farm packages for all the investors where they live. Look for out-of-state owners. Great opportunity. Go drive by the property. Take some pictures of it. Print them. Send them a note. Say, hey, I specialize in investment property in the area. So sometimes you need a referral for a plumber or an electrician or something. is there something I can do to help you, or you have any questions? Call me. That's my area of expertise. By the way, some of our clients are taking their out-of-state properties because they've inflated so much, and they're buying something closer to where they live. If you have any questions, there's no obligation. It's my pleasure. Enjoy the pictures of your property. There's so many ways to make new friends by talking about what's important to them, because you're talking about their money. And they don't want to be sold. They want to know, how do I do better? And that's what they're interested in. Let's do a seminar where you bring not people who want to be investors. They don't count at this point. I mean, they count, but not for this. For people who already own rentals, who've had them for 10 years, 15 years, 20 years. Let's educate them about the exchange and why they re-leverage to get more. Or maybe it's time to go into a property that takes less effort for them. They don't want to be managers anymore, property managers. Does that make sense? Those are the perfect people to talk with, because they're most likely to sell if they've got something better to buy. That's going to be better for them. I'm always happy to answer those questions. Let's do something like that here. Thank you, gentlemen, for having me here. It's always an honor and a privilege for me to be here. Plus, it's close. It's nice. I only come from Whittier, which is really nice. Anybody have any questions before we end today?
Maricela has a lot of questions, so don't be shy, Maricela. Go ahead and ask your questions. I know you're going to have me. You have something?
Is this Marcella? She should.
Right now I'm in the middle of my,
Oh, hey, congratulations.
but I'm on the 45 days
To identify. Have you found replacement property? Are you getting worried? See what I mean? Contingency language in the sales contract is so important, because you don't want to settle for anything. You want to buy a property that you feel good about. And if you're lucky enough to find it in 45 days, that's a good thing.
I have my agent working.
Oh, you have your agent working? Who's your agent? Martine? What are you doing in here, Martine? Get out there and go find some property. Thank you, everybody.